Charlie Munger once warned us, a lot of people with high IQs are terrible investors because they've got terrible temperaments. You need to keep raw, irrational emotion under control. Those words ring especially true today as we watch supposedly rational investors make decisions driven more by fear and uncertainty than by cold, hard analysis. Charlie understood that the biggest market moves don't happen because of spreadsheets. They happen because of psychology, politics, and the slow erosion of trust. Keep that wisdom close as we examine what's unfolding right now in the global bond market, because what we're witnessing might be one of those rare moments when the entire financial world's assumptions get challenged all at once. Hello everyone, and welcome back to the channel. Thank you so much for being here and for your continued support. Today we need to talk about something that honestly sends chills down my spine when I think about the implications. Europe may actually begin selling US Treasury bonds in response to escalating conflicts with the United States. And this move could trigger a catastrophic collapse of the US dollar. I know that sounds dramatic, maybe even sensationalist, but stick with me because the evidence is mounting in ways that are genuinely unprecedented. For many decades, really for as long as most of us have been alive, US Treasury bonds have occupied an absolutely unique and special place in global finance. They weren't just another bond you could buy, just another investment option among thousands. They were considered the ultimate safe asset, the ultimate safe haven, the absolute bedrock foundation of pension funds, central bank reserves, and long-term institutional investors around the entire world. When uncertainty rose anywhere on the planet, when geopolitical tensions flared, when markets got volatile, money from every corner of the globe flowed into US government debt almost automatically, like water flowing downhill. That fundamental assumption, that US Treasuries are the safest place to park your money during a crisis, is now being tested and challenged in ways we haven't seen for a very, very long time. Perhaps not since the 1970s or even earlier have we seen this level of doubt about American government debt. This week, the cracks in a US-led global financial system are widening visibly, and they're impossible to ignore if you're paying attention. Denmark's Academic Pension Fund, this is a major pension fund that represents academics and professionals across Denmark, announced something absolutely shocking. They plan to exit US Treasury holdings entirely by the end of this month. Not by the end of the year, not gradually over the next few quarters. By the end of January, they want to be completely out of US government debt. And the reason they gave wasn't some technical concern about yield curves or duration risk or any of the usual financial jargon. It was starkly, brutally political. The fund's chief investment officer made an extraordinary statement that should wake everyone up. The United States is basically not a good credit anymore, and long-term, US government finances are simply not sustainable. Let that sink in for a moment. This is an extraordinary statement, an extraordinary admission coming from a conservative pension fund manager, exactly the kind of institutional investor who is supposed to be boring, cautious, and definitely not making inflammatory political statements. These are the people who manage retirement money for teachers and professors, not wild speculators making provocative bets. And yet here they are, publicly declaring that the United States government is no longer a good credit risk. Think about what that means. Without a doubt, I believe more investors and more pension funds around the world are going to follow this lead like dominoes falling in sequence. They will follow suit because the risks have simply become too high and the volatility too extreme for fiduciaries responsible for other people's retirement savings. Washington has systematically undermined global trust not only in its political institutions, which has been obvious for years, but now also in the Federal Reserve itself. The Fed's vaunted independence, which has been the cornerstone of American monetary credibility for decades, is being not just tested but actively challenged and destroyed right in front of our eyes. The Danish fund explicitly stated that US finances are no longer sustainable due to weak fiscal discipline, which is objectively true if you look at the deficit numbers. They cited a weakening dollar, which I just posted an entire video about yesterday if you want to dive deeper into that. And they even mentioned the bizarre push for Greenland as evidence of erratic, unpredictable American policy that makes the US a risky investment. Now you might think Greenland is just a distraction, just Trump being Trump. But to foreign investors, it signals something deeper and more troubling about American priorities and stability. Here's where the numbers get genuinely frightening. European countries collectively own $3.6 trillion worth of US Treasury bonds. That's trillion with a T. That represents about 40% of all foreign holdings of American government debt. If other European countries start following Denmark's lead and begin systematically dumping their treasury holdings, what happens to the market? Basic supply and demand tells us that yields will spike dramatically as all that selling pressure floods the market. And spiking yields mean the US government's borrowing costs rise to potentially unprecedented, unsustainable levels. Eventually, if this trend accelerates, it could trigger a cascading implosion of global financial markets. We're not talking about a bad week or a correction. We're talking about a potential systemic crisis that makes 2008 look manageable by comparison. Now, on paper, the Danish Academic Pension Fund might not seem like a market-moving giant. Based on the reports I've seen, their treasury holdings amount to roughly $200 million. Not nothing, but not huge in the context of multi-trillion-dollar markets. But the signal this sends, the psychological impact, matters enormously. And this is happening at exactly the moment when global bond markets are already under severe, intense stress from multiple directions simultaneously. U.S. Treasury markets reopened for trading this week after the holiday to find themselves caught in what can only be described as a perfect global storm. Over in Japan, government bonds have been in absolute freefall. Yields on Japan's ultra-long 40-year debt have surged above 4%, which is the highest level ever recorded in history. The bond sell-off in Japan has rippled outward like shockwaves from an earthquake, hitting long-dated bonds everywhere from Europe to the United States. These markets are deeply interconnected through currency swaps, arbitrage trading, and institutional portfolios, so when one major market moves violently, others follow. At the exact same time these bond market stresses are building, political tensions have been escalating sharply across the Atlantic. President Trump has reignited his aggressive confrontational push for American control over Greenland. Now, Greenland is an autonomous territory within the Kingdom of Denmark. It's not just some random island. Once upon a time, Trump's interest in buying Greenland might have been dismissed as just another provocative talking point, the kind of thing Trump absolutely loves to throw out there to dominate the news cycle and keep everyone off balance. But now this isn't just talk anymore. It comes with concrete threats that include imposing tariffs on European countries, using trade policy as leverage in this territorial dispute. This is genuinely unprecedented behavior toward close allies, and markets are reacting accordingly. They don't like uncertainty, and this is uncertainty on steroids. Markets reacted very, very fast to this escalating situation. U.S. Treasuries sold off hard in early trading this week. The 30-year Treasury yield jumped more than 10 basis points in a single session, nearing 4.95%, the highest level we've seen in 4 months. The 5-year and 10-year yields pushed to levels we haven't seen since August of last year. The calm, predictable U.S. bond market that investors have relied on for generations may have officially ended. We might be entering a new era where U.S. government debt is actually volatile and risky. The dollar weakened sharply this week as a direct result of Trump's aggressive foreign policy moves, falling to a 2-week low. Think about the symbolism here. The United States is becoming the source of global uncertainty and instability, not the safe haven from it. That represents a complete reversal of America's traditional role in the global financial system. The Danish pension fund's decision didn't cause this entire market move by itself, of course. But it amplified it psychologically. It gave institutional investors around the world permission to think the unthinkable and say the unsayable. Maybe U.S. Treasuries aren't actually safe anymore. There will be more funds that follow this example. There will be more investors, more companies, more sovereign wealth funds, more central banks that follow this lead. I'm absolutely convinced of that. The exit from U.S. Treasuries by a respected European pension fund speaks to a much broader, deeper shift in how global investors are fundamentally reassessing the political risk associated with investing in the United States. The perception is building that America is too unpredictable, the political environment too volatile, the fiscal trajectory too unsustainable. There's just too much risk involved for what's supposed to be the safest asset on Earth. And critically, this isn't happening in a vacuum. Japan's bond market is playing an absolutely critical role in this story, despite what Treasury Secretary Scott Bessent tried to suggest in his public comments, downplaying the situation. Concerns about Japan's fiscal outlook and rising inflation expectations have pushed Japanese government bond yields sharply higher. I'm planning to upload an entire dedicated video on this Japanese situation, or I may write a comprehensive post about it over on my Substack or Patreon. I haven't decided the best format yet, so stay tuned if you're interested in the details. But here's why Japan matters so much to this story. Japanese investors are among the absolute largest holders of foreign bonds in the world, including massive holdings of U.S. Treasury bonds. Japan's institutions have been reliable buyers of American debt for decades. But as yields on Japanese government bonds at home rise and become more attractive, the economic incentive to repatriate that capital back to Japan increases dramatically. Why take currency risk and political risk holding US bonds yielding 4.5% when you can hold Japanese bonds at home yielding 4% with no currency exposure? That's where the real systemic danger lies for Washington and for the dollar's status. If large pools of foreign capital begin flowing back to their home countries, not out of panic or crisis, but out of completely rational, calculated yield considerations and risk management decisions, borrowing costs in the United States could rise structurally and astronomically. We're not talking about a temporary spike that gets smoothed out. We're talking about a permanent repricing of US credit risk. Japan may very well become the true accelerant, the real catalyst, behind both a treasury sell-off and a dollar collapse. Their market is so large and their holdings of US debt so massive that their decisions move global markets whether they intend to or not. Now, if we layer escalating political risk on top of these already concerning market dynamics, the picture becomes even more uncomfortable and frankly scary. Here's the pattern we've seen repeatedly. Trump pushes uncertainty and confrontation to its absolute limits through threats and aggressive rhetoric. As a direct result, bond yields spike upward, stocks wobble and fall, the dollar weakens, and then, only then, does the rhetoric soften somewhat. It's like touching a hot stove and pulling your hand back. The market reaction serves as a rude awakening to the madness and forces a tactical retreat. But this time, I would argue the stakes are fundamentally higher than previous episodes. The Greenland dispute isn't just another trade negotiation or tariff threat that can be walked back with a tweet. It has raised deeply uncomfortable questions throughout Europe about the entire post-World War II international system and framework that's been in place for over 7 decades. People are genuinely asking whether that system still exists, whether the rules still matter, whether America can still be trusted as the guarantor of global stability. The idea that European countries might actually weaponize their enormous holdings of US bonds and US stocks was once dismissed as completely unthinkable, the kind of thing that could never happen between allies. Now it's being openly debated in financial media, in government circles, in pension fund boardrooms. That shift in conversation alone is remarkable and disturbing. But let's be brutally honest about the European position here. The European Union cannot actually afford to sell US treasuries in any massive, coordinated way. They really can't. European economies have been in a downward spiral for years now, not months, not weeks, but years of stagnation and decline. Germany, which used to be the economic powerhouse of Europe, has actively deindustrialized as energy costs have soared and competitiveness has eroded. France is dealing with political instability and massive debt. Italy has been struggling for over a decade. So the EU cannot afford to precipitate a financial crisis at this particular moment in their economic cycle, and Washington knows this very well. American policymakers are banking on European weakness and dependence. But here's what Washington either doesn't know or refuses to publicly admit: their pure aggression on the international stage, their unpredictable threats and confrontational behavior toward allies, is causing the world to gradually but inexorably shift away from the US dollar as the global reserve currency. And shifting away from the dollar means shifting away from US dollar-denominated assets, including American government debt. This isn't happening overnight. It's not a light switch that gets flipped. But the trend is unmistakable if you're watching carefully. If foreign appetite for US assets continues to weaken over time, the consequences for America won't be pretty at all. Higher yields mean dramatically higher borrowing costs for the United States government, which is already running trillion-dollar deficits. It means higher mortgage rates for American households trying to buy homes. It means more pressure on already severely stretched public finances that are barely sustainable even at current interest rates. There's a $13 billion auction of 20-year US bonds coming up very soon, and that auction will serve as a crucial test. It will gauge whether global investors are still willing to absorb long-term American debt at current prices and yields. Weak demand at that auction, if the government has to pay higher yields than expected to attract buyers, would send another unmistakably clear signal that something fundamental is shifting in how the world views American creditworthiness. I will definitely keep you posted on the results of that auction and what it means for the bigger picture. Here's the uncomfortable truth that's becoming harder to deny. The United States no longer looks like a predictable, stable actor on the global stage. Its fiscal trajectory is severely strained and getting worse every year. Its politics have become volatile, chaotic, and deeply polarized in ways that make long-term planning nearly impossible. And its trade policy has become openly confrontational and aggressive even toward its former close allies, countries that have been American partners for 75 years. A conservative European pension fund managing teachers' retirement money is no longer simply asking the traditional question, do U.S. Treasuries yield enough to meet our return targets? They're now asking a much more fundamental existential question. Do U.S. Treasuries even deserve to be treated as risk-free assets at all anymore? That is a profound shift in thinking. That's not about interest rates or technical analysis. That's about trust, credibility, and the very foundation of the global financial system. And if more institutional investors around the world begin asking themselves that same question, not in panic, not irrationally, but gradually, methodically, as part of prudent risk management, the cumulative impact on global markets could be far greater and more destabilizing than any single dramatic sell-off. This would be a slow-moving crisis, which in some ways is more dangerous because there's no obvious moment to intervene and stop it. Charlie Munger would have looked at the situation and likely said something characteristically blunt, "Show me the incentive and I'll show you the outcome." The incentives for foreign investors to hold U.S. debt are weakening while the incentives to diversify away are strengthening. That's not a political statement. It's an observation about how rational actors respond to changing circumstances. What concerns me most isn't any single event or data point. It's the accumulation of signals all pointing in the same direction. We have political instability and aggressive foreign policy. We have unsustainable fiscal deficits with no plan to address them. We have a Federal Reserve whose independence is being openly questioned. We have yields rising globally, making U.S. debt less attractive on a relative basis. And now we have respected institutional investors publicly declaring they're exiting U.S. Treasuries entirely because America is not a good credit. When you put all those pieces together, the picture that emerges is genuinely troubling. We might be witnessing the early stages of a major shift in the global financial order, where the U.S. dollar gradually loses its privileged status as the world's unquestioned reserve currency. That process could take years or even decades to fully play out. But once it starts in earnest, it's extraordinarily difficult to reverse. The consequences of that shift for American living standards would be profound. The U.S. has benefited enormously from dollar privilege, the ability to borrow in our own currency at low rates because the whole world needs dollars. If that privilege erodes, Americans will discover that we've been living beyond our means for a very long time, and the bill is coming due. I don't say any of this to create panic or fear. I say it because understanding these dynamics is crucial for anyone trying to protect their wealth and make informed investment decisions. If you believe, as I do, that the trends I've described are real and accelerating, then your portfolio needs to reflect that reality. Maybe that means holding more gold and precious metals as a hedge against dollar weakness. Maybe it means diversifying into foreign currencies and assets. Maybe it means being very careful about long-term U.S. bonds that could suffer significant losses if yields continue rising. Whatever your specific strategy, the key point is this: don't assume that the financial system will continue operating exactly as it has for the past 40 or 50 years. The assumptions that guided investment strategy for decades, that U.S. Treasuries are absolutely safe, that the dollar is unshakable, that America's creditworthiness is beyond question, those assumptions are being tested right now in real time. Charlie Munger built his fortune partly by being willing to question conventional wisdom and think independently. He didn't just accept that everyone knows something is safe or profitable. He dug into the fundamentals, examined the incentives, and made his own judgments. That's exactly the approach we need today. Thank you so much for joining me for this analysis. I know it's heavy stuff, and maybe it's uncomfortable to think about. But I genuinely believe these issues are critically important for anyone who cares about their financial future. If you found value in this breakdown, please consider supporting my work. I truly appreciate every single one of you who has become a paid subscriber to my Substack or Patreon. Your support allows me to keep producing this kind of independent analysis without having to chase clicks or sensationalize stories. I look forward to seeing you here tomorrow as we continue tracking these developments. Take care of yourselves, stay informed, and remember, in times of uncertainty, knowledge and preparation are your best assets. Claude is AI and can make mistakes. Please double-check responses.